Okay, let's dive right into this explainer. Today, we are acting as a strict, no-nonsense value investment committee. We're tackling the paradox that is Take-Two Interactive, ticker symbol TTW. Now, on one hand, this is an absolute cultural behemoth, right? It's the company behind Grand Theft Auto, which commands massive, record-breaking hype. But on the other hand, as value investors, we're staring down some seriously concerning GAAP net losses. So we're going to combine Warren Buffett's qualitative value investing framework with some rigorous quantitative valuation, relying strictly on the filings and reports we have in front of us to build a definitive investment thesis.
To arrive at our definitive conclusion, we'll follow a pretty strict sequence. First, business and economic moat. Second, deep financial statement analysis. Third, rigorous valuation models. Fourth, our margin of safety check. And finally, number 5, the final value investing verdict.
Let's kick things off with Section 1, Business and Economic Moat.
So the crucial starting point is really understanding the core business model. In a nutshell, Take-Two Interactive is a titan of interactive entertainment. They develop, publish, and market games globally, principally through 3 major labels you definitely know: Rockstar Games, 2K, and Zynga. Their entire strategy revolves around delivering these massive blockbuster hit entertainment experiences across console, PC, and increasingly mobile platforms.
Let's see how Take-Two scores on the classic Buffett's checklist. Is it an understandable business? Yes, absolutely. They make and sell games. Do they have a durable competitive advantage? We rate this moat as definitively wide. The evidence is right there in their massive intangible assets and network effects. I mean, the Grand Theft Auto series has sold over 440 million units, and NBA 2K is over 155 million. The brand power and the switching costs in those online ecosystems are just staggering. But do they have consistent high returns on equity? No. Right now, they're operating with GAAP net losses. And able and honest management? We gotta say it's mixed. They execute well in the games, but as you'll see, we're noticing some real shareholder dilution.
Now, when assessing management quality, you really have to look at capital allocation. CEO Strauss Zelnick projects immense confidence here. He explicitly highlights their disciplined approach to M&A, pointing out that their integrations of major purchases like Zynga and Gearbox have worked out really well. From a qualitative standpoint, management is super candid about focusing on efficiency and driving high recurrent consumer spending. But, we have to see if the cold, hard numbers actually match that narrative.
Which brings us right to Section 2, Deep Financial Statement Analysis. Let's look at the math.
Looking at the income statement, we see this really high contrast juxtaposition. In Q1 of fiscal year 2026, GAAP total net revenue grew nicely to $1.5 billion, which is up from $1.33 billion the prior year. Great, right? However, the company continues to operate at a significant GAAP net loss, $11.9 million just for the quarter. And even more concerning for earnings consistency, their full-year FY26 guidance projects a massive net loss, ranging from $377 million all the way to $442 million. So the top line is growing, but the bottom line is bleeding. And guys, we have to flag a major value investing red flag right here. Management is very quick to tout their non-GAAP EBITDA of $225.5 million. But if we look closely at capital allocation and owner earnings, the reality is consistent shareholder dilution. The share count isn't falling, it's actually rising. Basic shares outstanding jumped from 172.3 million to 180.8 million year over year. Plus, they incurred over $40 million in stock-based compensation in just one quarter. This kind of aggressive non-GAAP accounting really masks the true cost to shareholders. Now, on the flip side, the success of their strategic pivot, primarily driven by the Zynga acquisition, is incredibly clear here. Just look at this breakdown. Mobile now makes up the lion's share of bookings at 56%. Furthermore, recurrent consumer spending, so things like virtual currency and in-game ads, accounts for roughly 83% of total net bookings. This is actually incredible for earnings predictability, because they're no longer purely reliant on those massive hit-driven upfront game sales. Turning over to the balance sheet, there is definitely strength but also leverage. The company boasts over $2 billion in cash and cash equivalents. Awesome. However, we absolutely cannot ignore the total debt load, which exceeds $3 billion when combining short and long-term obligations. This leaves them in a net debt position, which is something we definitely have to factor into our enterprise valuation.
All right, Section 3, Rigorous Valuation Models. Let's see what the business is actually worth.
Building our discounted cash flow model requires some transparency. Since specific historical free cash flow growth rates and the exact metrics to calculate WACC aren't explicitly broken out in the provided filings, we've got to assume a standard 10% discount rate to proceed. But here's the really critical finding.
Management's own FY26 guidance projects $130 million in operating cash flow against $140 million in capital expenditures. That means, right now, owner earnings, or free cash flow, is negative $10 million. And as we all know, you literally cannot discount negative cash flows into a positive valuation. Next up, we look at the Graham intrinsic value formula. Again, running this is incredibly tricky. Management's GAAP EPS guidance is heavily negative, between negative $2.40 and negative $2.05 per share. Even if we substitute the adjusted analyst consensus of $2.76, we're forced to assume a highly optimistic growth rate based on the upcoming 2026 launch of GTA 6. Furthermore, without a stated AAA corporate bond yield in these reports, we have to just assume a 4.5% yield. The bottom line? The output of this formula is highly speculative because it's built entirely on future promises, not present stable GAAP earnings.
For relative valuation, we're honestly flying a bit blind. The 5-year historical averages for PE, price to book, and EV to EBITDA, as well as peer group comparisons, just aren't detailed in these specific financial reports. What we do know is that they have an enterprise value of over $44 billion against negative current GAAP earnings. That alone tells us they're trading at an incredibly steep premium.
To run a reverse DCF, to see exactly what growth rate the market is currently pricing in, we normally look at today's exact fluctuating share price. But even just looking at the astronomical $41.78 billion market cap, the math implies the market is pricing in flawless execution and massive growth over the next decade. There's almost no margin for error.
As for the dividend discount model, we can skip it entirely. Take-Two relies purely on organic reinvestment and M&A rather than returning cash to shareholders via a dividend. So, moving on.
Section 4, Margin of Safety Check.
So the crucial point here is this gaping chasm. We have a company valued by the market at nearly $42 billion, but it's generating negative free cash flow today and projecting severe GAAP net losses for the full year. Establishing a 25 to 30% margin of safety below intrinsic value is, well, mathematically impossible with the current data. Why? Because the intrinsic value based strictly on present cash flows simply does not support that massive market cap.
Section 5. Final Value Investing Verdict. The Moment of Truth.
For our investment committee, the clear verdict is a pass. Look, Take-Two Interactive is unquestionably a wonderful business. It possesses an incredibly wide economic moat, driven by the truly unrivaled cultural power of franchises like Grand Theft Auto and NBA 2K. The quality of their recurrent consumer spending is excellent. However, this is heavily offset by massive operating expenses, high stock-based compensation, and shareholder dilution. They're trading entirely on the future promises of their 2026 game pipeline rather than present cash flow. So, it's a great business, but at its current valuation, it completely lacks a fair price and a margin of safety.
I'll leave you with this provocative thought to consider before you make your next investment move. Everyone is waiting for GTA 6, right? But if the hype surrounding the most anticipated entertainment product in history can't pull the company's free cash flow into the green today, is the moat truly wide enough to justify a $42 billion premium? Think about that, and I'll catch you in the next explainer.